Today is one of the two most anticipated reports of the year from Gary Glover because it's the start of the new financial year and we're looking at the dogs of the Dow phenomenon. So being the new financial year, these are trades that we look at right now in July. And we know from years of recording together that on the ASX, we can often see that the worst performing companies and shares of the last financial year, they get sold down for tax loss selling into the end of June. Then like magic, as the calendar ticks over to the new financial year, the start of July, that selling pressure just evaporates. And if you pick the right shares, they can take off, just like letting go of a basketball underwater. And to that point, we say, good morning, Gary Glover. How are you?
Yeah, excellent.
So we're going to look at the dogs of the Dow and you'll talk about the theory, what it is, and some sort of performances of it. But it's probably important to check in on those indices. So when we're having a look at the indices at the moment, we'll start off with the NASDAQ. How's that looking at the moment? Is there any change with this bearish engulfing that you've highlighted in the report?
The bullish engulfing. Yeah, still haven't got much of a bearish signal there so far. Just a little tight range there obviously the previous fortnight. But yeah, that bullish engulfing pattern there last week still pretty strong there. Still not seeing any sort of volume on the down days there, Chris. So still pretty constructive. Look, there's a few levels ahead here. Typically sort of July, August in these sort of pre-election years and also these third years, you can get a little bit of congestion there. But as we know, there most of those sort of third years we haven't seen, most of the drawdowns are between 2 to 5%. So pretty small. So we're just not expecting to see too many decent pullbacks in this market there. But that July, August period is probably the more murkier sort of messier months. So I do expect maybe we'll go slightly higher here, maybe pull back into sort of like a small, 3 to 4% drawdown into August, maybe like a little ABC, so something sort of, more of a flat sort of structure rather than anything too deep. And then away we go again. But I think overall still pretty constructive there. There's nothing too negative there at all.
And for the S&P500, it still appears to be in this channel that you've highlighted and talked about for the last couple of weeks, just tracking on the inside of the upper bandwidth.
Yeah. So another bullish engulf in there as well. So outside week, just shy of the upper trend line. So yeah, I just sort of think sort of similar to 21 there. I think it'll just track that, that trend line there. So I think it'll go up there, but yeah, maybe it'll sort of, just sort of congest and, climb slightly higher. Maybe we'll get a little bit of a pullback into August of some sort and then they can climb back up again. So, but yeah, nothing too negative there. Just, we've had a decent run here, but again, just can't expect to, the drawdowns historically and these sort of third years are pretty small here. So, so I think, we're just, typically sort of 2 to 5%. So just, I think if you're trading those indices, I think if the market pulled back 3 or 4%, you're jumping back in, so, yeah.
Well, the XJO has been notably different. So if we have a look at the Aussie, we can see that we talked about, or you mentioned for some time the 4 weeks up. After we crossed over 4 weeks down, you said, look, we'll probably go for 8. We got there and then we roared on up and came crashing back down quite quickly. What's your take on these last couple of weeks that we're seeing on the Aussie?
Yeah, so the CPI figure that was sort of scared the market. Yeah, so with obviously interest rates, getting pushed higher here as well. So just some of the economic data there has, it's probably more around interest rates having to go higher in Australia. And the reality is we're so far behind the rest of the world, and most of the countries that have sort of kept their rates on the lower side, they haven't been able to get in front of inflation. Whereas with most of the countries that are sort of, got themselves to sort of 5.5% of the cash rate, they have seen the largest sort of influence in terms of inflationary pressures easing off. So it just, so that's probably been the concern here. That's sort of caused that sort of settle down. But look, probably a bit of a shakedown in some regards. We've had a bit of a bounce again, so I think we're now back above that channel, although not back above the high. But yeah, we've still got interest rate decision again today, Chris, so it might add some more volatility. So yeah, I'm kind of, maybe it's just me hoping here, but I can't see why the rate's not going to go higher. I think really those inflationary pressures are sort of still, because even though inflation numbers are still a bit down, they're still pretty high. And I mean that like the wages, that 8.5% increase in wages, that just kicks in now. So that's going to have an inflationary pressure moving forward there. Some of those energy costs as well, they kick in now as well. So got a lot of extra inflationary pressures just hitting us now. So I can't see how the RBA can keep rates where they are, just based on what's happening globally. So I think they'll go higher there, which just might cause a little bit of a jitter in the market again. So we could get another little shakedown here. I'm still pretty buoyant, but I just think the RBA here is probably going to cause a few jitters. So it wouldn't surprise me to sort of see over 25 here this afternoon. Maybe retailers might get a little bit of a pull back again. I think I sort of mentioned last time we bought some Harvey and all some of the retail stocks because I thought they'd been oversold. And some of those valuations were so much lower than the 10-year averages. And we've seen a bit of a bounce in those, but wouldn't surprise me to sort of see those drift up again here. And hopefully that's the case here because they've had a nice bounce, pretty good volume on those retailers. It'd be nice to sort of see that maybe come back, make a first higher low, see maybe a bit less volume on the sort of setup here. But yeah, look, we'll know sort of around 2:30 this afternoon. It's probably one interesting map, but I think, still sort of constructive for mine here, but we're probably going to get a bit of extra volatility here this week. I mean, look, you never know what goes on. He might put the pause on here and say we're all fine, and market might open the shutters and go up. He really, I've got no idea that there's a governor there that I've normally someone's got a slant that which you sort of would expect. He seems to be all over the shop, so I don't think there's any sort of particular slant there.
Right. Well, as you said, we'll see this afternoon, and that will have an impact on the market, and particularly those retailers, which some of them do feature in the list that we'll have a look at later. Just the last indices before we jump into it is the Dow itself. So the Dow, it's still been churning along. Now it's on that overhead resistance, just been getting above and below, but still sort of those last three trading sessions, or 3 weeks, we should say, are fairly tight. Does this change your outlook at all?
No. So I mean, really, basically, sort of, got that sort of, kind of consolidation pattern there, and the price action has stayed nice and tight up near the high, which we sort of know is, often historically a good sign. Volume's been pretty light on the sell downs, so sort of haven't really seen any sort of heavy volume on those sort of down days or down weeks and stuff as well. So yeah, so it looks pretty constructive. Looks like it's sort of ready to kind of break up here. So yeah, looks like it's sort of trying to push high here. So I think once we sort of go to a near high there, I expect it to sort of to kick on there. I think I mentioned that the NASDAQ's had a pretty good run, and the Dow's probably underperformed a little bit here. At the start of this bull run, actually, the Dow was actually the one that led the market out of the low. So I expect that, not like growth will have its little curve here and there, but I'm kind of expecting that maybe the Dow might outperform here over the next sort of month or two. So I do like to look at this.
Well, that period from here on in, we are in the new financial year. It's less of an issue for the US, where their financial year coincides with the calendar year. But for us, we tick over. We have a few extra things, which is in the financial year, the tactical selling and the likes. But do you want to explain to us what the dogs of the Dow Theory is and how those historical performances have tracked, just to give us a bit of an idea of theories more than what you and I have talked about for the last few years?
Yeah, so look, we know there's sort of obviously tax selling, which does sort of put the foot on the throat of some of those sort of stocks. There's also like the this sort of dogs of the Dow theory, which is sort of, it's been around for a long time actually. It's where the theory basically is buying the worst 10 performers in the Dow for the next financial year. And I think, typically those sort of stocks, they're the big caps. They're generally looking for the stocks that pay a dividend. And I know that those who sort of do use the strategy sort of for themselves, they typically look for companies that have got maybe a company-specific issue rather than an industry issue. When I first looked at it, I thought, surely you go for an industry issue because then obviously the industry can bounce back. But no, they like to sort of see, a company which has gone through a little bit of trauma, you might say, or some issues, and then so just that company itself there. And yes, I mean, it's had, you can look at some of the figures there over 10 years and over 20, 30 years. So, the strategy has been pretty sound there. I saw someone actually, might have been Livewire, someone actually had the 10 picks last year. And again, that this was looking sort of through the top 200. There wasn't the bottom 10 or anything, but obviously it was their sort of list. And I think 9 out of their 10 actually performed pretty well. I think the one that I can't remember what it was now, it might have been Domino's, was off another 30%, but most other stocks were pretty well there. So I think about 6 or 7 from my list are on their list this year, which I was happy about. But yeah, there's definitely some opportunities there from some of the stocks there. So me personally, I've sort of gone through the list, gone through the 300 and tried to look down the bottom of the list and which ones have sort of had the largest gains, looking for stocks that sort of, do meet that criteria, probably a larger cap, do pay a dividend or have typically paid a dividend most of the time, and companies that have more sort of had specific issues rather than company issues there. And so BUBs was sort of one that was one of the biggest, down year. So it's down 70% year on year. And, considering this has probably had a 2-year bearish run now, that's sort of saying something just from the 1 year. So the thing I like about it here, 2 things, it's sort of come back to retest the old low. So it has gone to a new low there, which I always like to see that. And I do like to sort of see some volume into the market crash as well, start to see some accumulation below there. So those are just things I look for technically. So I think there's been obviously some sector issues here recently, but this has had some company specific issues there for probably for the 18 of the 24 months on the downside here. So I don't mind a look at this actually here. I think some risk here for sure. But it definitely looks like one that could be could have somewhat recovery. I personally sort of play a lot of these stocks mainly just for the month. I know the dogs of the Dow theory is looking at these things for 12 months. But I just typically find that this you do tend to get that extra selling into the end of the financial year. We tend to sort of sell our losers off and bank those losses against the gains for the year. So it does sort of keep extra pressure on those sort of underperformers. And then I find they sort of tend to bounce in that first month there. So I'm probably going to look at these 10, 11 stocks here at the end of the month, see how they've gone for the 1 month, and then we'll look at how they've gone for the year as well. So 12 months from now, we'll keep an eye on that.
Well, another one that's got a lot of headlines in the last, well, not only the last 12 months, but the last 2 years, and I guess your chart's showing that as well, is the Star Entertainment Group, SGR. You're showing it's down about 55% for the year, so pretty terrible performance. How do you see this chart?
Yeah, it's a big one. So look, I know the industry has had a few headwinds there, but I mean, Crown had a few got caught being a bit naughty, a bit like sort of Star there, and then obviously Crown did bounce and then get taken over. So, so Star's sort of obviously, had some very company specific issues there, and has sold off quite a lot here. So here's a company that typically does pay dividends historically there. So look, sector, this one's probably a bit more. This one definitely comes with some risk there. Rising interest rate environment, possibly puts some strain on something like this. But I still think people are still looking to get out be entertained here. But yeah, this one's really gonna, I think, something like 2/3 of the management's been cleaned out of this company, Chris. So I think there will be some big change coming here. Or just this one might take a little bit longer to recover, but no doubt about how large that decline is and how big a beat up it has been. So definitely see this one, kind of recovering somewhat.
One other one that you mentioned in the last couple of weeks is Elders. So they're down 47, just under 48% over the year. And their weekly chart shows that really 2 periods of high acceleration of the drop. And then into the more recent close, you've got the 1, 2, 3, the 4 lower lows coming down, retesting the old low of the chart, and then good volume. So given this in the report last week, you're still looking like it's a possible trade, or is it kind of already horses?
Yeah, I do like this one, Chris. I like this one for 2 reasons. Obviously, it's had a big decline there, so at 48% just the year on year, and obviously it's been trending down for a bit longer than that, so that's even good there. So as much as that chart doesn't look pretty, it's very sort of straight line down, which is impulsive there. It is a stock that has a history of this, so the sort of stock had sort of been winding its way high, and it never really had too many sort of V-shaped bottoms or V-shaped sort of sell-offs there. They'd probably be a bit more wary. But if you look at this sort of stock, historically go back and look at 30, 40 years of sort of, I'm not sure how far it goes back, but if you look at the last 20, 30 years of sort of data, you'll see that this stock really is a stock that really trends. So it's almost sort of like a future sort of commodities that really goes up strong, comes down strong, goes up strong, comes down strong. So it's got a history of actually really trending, and it's really a high beta sort of stock there. So it'll tend to outperform on the upside, and it will outperform on the downside when the market cools off here. So its inherent nature is to go up big and go down big. The reason I like it here is that it's come off pretty bit. There's been a few management issues in there as well. Obviously, some industry issues, but I noticed like something like GrainCorp certainly sort of hasn't had the sort of decline that this has. There's had a few management issues as well, but I love the fact here that we've had like a big 90% decline here on the weekly range, and the last probably 4 to 6 weeks here we've seen some big volume down at that low there. So sort of signs of accumulation potentially taking place with the stock sort of off here. So that's the sort of things I like to sort of see technically. And it is a stock that has an erratic nature, so that gives it every chance of actually having a V-shaped low and then bouncing out of it as well.
Another one is Domino's Pizza. They've been the darling. They've been growth engine. They've been one of the best performers, and that chart that you've got on screen here is just nothing short of phenomenal. 40 up to 170 pretty quickly.
Yeah,
they came crashing down. As you noted, it was one of the ones from the previous year that had a heavy down year into July, and it was one of the only ones to end up closing lower once again. So could this be its time to turn?
Could possibly be. I mean, I do like the fact that it's now sort of had a second year sort of downward pressure. It is the biggest risk for this one, Chris, is it is in a downgrade cycle. So I think the last 3 reports have disappointed. So we've had obviously the issues and failing in Italy, the home of the pizza. But it also has a sort of downgrade cycle there. But we've seen a bit of a elevated volume sort of at the sort of at the lows there for the stock here, the last sort of 2 or 3 key lows there. So it does look pretty deep here. There looks still some risk there, just because it is in that downgrade cycle. But this is one of those stocks, Chris, if we do get an earnings surprise, so the earnings are actually above expectations or on the positive side, this is one that will move. So it won't be too late to follow, just because it is in that, sort of, I know typically sort of a lot of fundamental guys won't touch stocks that are in the downgrade cycle. They'll only step in once it changes. So if we do get a positive uptick in earnings, and that's on the positive side ahead of expectations, that's when they all enter. So even if it gaps up a little bit, might gap up 5-6% or something, that'll be there'll still be a sort of change on there. So this is definitely one to keep an eye on here this year. I think the next earnings report will be really important there. So
well, there's another one which is ACL, and you've spoken about this one before, looking at this nice tight channel, 5 up, 10 down. We saw it on the ASX and that performed well for it to shoot up. What are you looking for? Same thing on the cards, possibility for ACL?
Yeah, look, like the sector, still a sort of growth company. They're sort of small, so still can sort of grow here. I like the chart as well, the fact that we've sort of had a bit of bounce and then pull back here. Trying to make a play for a company twice their size as well has probably hindered them a little bit. So don't see that being successful personally. So, so this one looks pretty encouraging there. Just oftentimes those sort of newer companies, they'll start off a bit hot, come back, retest to lower, then they sort of start to build again. So that's just a bit of a popular cycle I noticed with new companies. So so this one does look sort of constructive to me.
And staying in that healthcare space, we've got Ramsay Healthcare, which is surprising to see they're one of those poor performers, given how that sideways channel has not really gone anywhere for about 2 years. So what do you see on this chart here?
It is interesting, really, because sort of forecast earnings are sort of set to grow over the next couple of years. The issue that Ramsay has got here is that that sort of turnaround, sort of post-COVID, is happening a little slower than analysts would like to see. So we are seeing a recovery in earnings, but maybe just not as fast as some would like here. So, but yeah, definitely a bit of a quality player there. But yeah, I noticed it went to a new low as well. So a bit of volume down here, but yeah, definitely, to me personally, I sort of, I do like a lot of these stocks there, but I would still be putting a stock in there, Chris. So I think, the old William and ELD, maybe 8% is probably a good one for these sort of, dog of the Dow sort of stocks there. Because I think I sort of saw most of them that were up from last year on the ASX were maybe, 25 to sort of 35% sort of seemed to be a lot of them, the ones that had really recovered had a decent recovery. So if you're sort of looking for, like a 25 to 30% recovery, then, something like a third of that, around 8% or something, is probably a good risk reward parameter to look at there. So if you had that on Domino's last year, instead of being down 35%, you might only be down the 8%. And then if they continue to keep climbing the other ones, then you get the upside as well. So still got to use some risk management, I think, as part of your strategy.
Well, risk management is probably something that would have been front of mind for the ASX management team when we're talking about that failed chest replacement using blockchain and then writing off a lot. So risk management, essentially, hindsight probably could have done it earlier. That's obviously plagued the ASX for the last year or so with those market updates and having to write off a large amount of cash that was allocated towards a failed project. With that possibly getting the skeletons out of the closet, possibly getting that behind them and turning the ship around, do you think that could be happening in financial year 24?
Yeah, I noticed in that live report there, which had the dogs, the Dow, the ASX, trying to think who the fund manager was there, but they had ASX in their list. But they did say that was probably one of the ones they were least confident about, because they still believe that the multiple was sort of not compelling. But they did sort of say they didn't expect the IPO market to improve. Whereas I think the opposite, actually. I think, with equity markets improving here, then that leads to sort of the IPO market improving. And, we saw sort of, 2021, the number of cap raises was going through the roof. And then obviously 22, 23, things are really slowed down on the IPO front. So I think with the equity markets improving, that's likely to, be a positive for new offerings. And I sort of think this has been, the chess issue is sort of, much as it does sort of impact maybe cost pressures and stuff, that's not really impact the business, too much, I think. I really like this one here personally. So I think it's been a fairly decent correction there, 23% sort of year on year. Do like the sort of technicals that sort of come back and washed out sort of the old lows there. And we've definitely seen some big volume in the last 3 or 4 weeks. So, but I think sort of signs of accumulation taking place there. We're just sort of starting to build here too. So it's got a couple of high lows sort of building on the daily there. So again, got to use risk management there. But this is one that I quite like here. So we built a reasonable stake here. But yeah, again, I'll still be using risk management there, regardless of how I feel about any stock.
Nice. And that report that you're talking about is from Hugh Dive, NatWest Funds Management, who also won quite a market points. And for years before YouTube, we were doing the dogs of the Dow, this exact type of thing, last 6, 7, 8 years.
Yeah, I was watching a little video last night there, actually, of I think what's his name? Webster, who used to work for IBD, was sent through like a William O'Neill video. And William O'Neill basically says, there are no good stocks. The stocks are all bad. They're only good if they go up. And so you got to have that mentality that they all can go bad. So don't fall in love with the stocks. You can buy them, you have your risk management. But basically, one of the greatest, or one of the better traders on the planet saying that all stocks are bad and not to trust them it's just kind of refreshing. Just reminds you sort of to always have your risk management in place.
Well, that words of caution, William O'Neill. So if we go into the next one, Endeavour is probably one that is an example of all stocks are bad. It was one, as inflation was taking off, many investors flocked to this thinking that consumer discretionary might be curtailed with higher interest rates, but we'd probably still be buying from Dan Murphy's and the like and buying alcohol. And so many investors were shocked that it just didn't keep on performing after inflation had kicked in and interest rates had started going up. So that's a bad stock from that perspective for investors, but it's on your list. So could there be a turning point, or what's caught your eye?
Yeah, it's had a decent sort of year-on-year decline there, so 17%. Also gone through what I think is a bit of a normal sort of cycle as well. So a lot of those new companies, sort of IPOs or new to market there, they tend to sort of start on fire. Everyone sort of falls in love with them, and they often sort of get bid up, in the, whether it's the first 6 months or the first 12 months. And then they've got a history of sort of coming back and retesting the lows. And that's usually a result of sort of, when it's new and shiny and lots of news coming out, everyone gets excited. And then once the sort of the rhythm of the reporting starts to sort of slow down, sort of normalize, you're hearing less about it, then the stocks tend to retreat there. So it's not uncommon to be sort of seeing, what I think is a good quality company sort of come all the way back and retest the low. I would love to have seen it retest that 580 low there, but just didn't quite get down. They got down to the 21 low, just not the sort of starting low there. But definitely one I'm keeping a close eye on here. Love to see a constructive sort of first high and low setup, Chris, there. But definitely seeing signs of elevated volume here the last 3 or 4 weeks down at that low. So that, again, is sort of signs of possible accumulation as well. So it has come off quite a bit, and that's quite a common cycle there for the sort of new companies as well. So, yeah.
Well, Lendlease is the next one on the chart. It is not a new company. It has been around for a very long time. And it looks like it's been in a downtrend for quite some time as well. Could this be slowing as it's getting down here? We also note that you've got a few volume spikes towards the right-hand side of the chart. So.
Yeah. Yeah, this is a typical dogs of the Dow sort of stock there. Sort of large cap, does pay sort of dividend there. Had a few issues of its own there. I'd like it technically there, just because it's sort of like that first leg down. This next leg down is like 161.8%. That's a good sort of Fibonacci, kind of range of the first range, and I often sort of see that sort of technically. Just started to see really elevated volumes again down near the low here as well. And we've seen some of these other construction building stocks actually make a recovery here recently and start to move up here. So So although this is not leading in its area, Chris, the sector has had a positive turn here recently. So even the laggard might get dragged up here. So, but yeah, so I think this is sort of somewhat constructive there.
Well, another one is Harvey Norman. We're into that retail space now that you were mentioning earlier, and they are down, nowhere near as dramatic as the top ones that you mentioned, just down 7.2% year on year. Still not great if you're an investor and you're holding it. You always want it to be positive, but it's dipped under that recent low that we saw June, July, and then did it with a bit of gusto, got through it quickly and with a bit of volume. How's your read on this, the last few weeks on it?
Yeah, it was off about 13-14% there about a week or so ago. So it was sort of, it was looking pretty good in terms of the dogs of the Dow list, but it has bounced back pretty sharply here. I think I've mentioned actually in the last couple of weeks here that probably these companies reporting the bad news might be the sort of buy the rumor, sell the fact, and that was sort of the turning point there. I mean, Harvey Norman, I think, if you go back and look at the last 10 years of data there, it's I think the average PE sort of fits in around that 10 or 11 times. So we got down to around 5 here recently. So even if you sort of give it a bit of a haircut, maybe you say give it a 20% earnings haircut, you sort of still got it on, say, 6. So still really 6 or 7 is still historically very, very cheap compared to where it trades historically. And it does have property portfolio as well. Everyone sort of forgets that with Harvey Norman. So yeah, definitely some incredible value here. Wouldn't surprise me to sort of see, it's had a nice bounce here. Got the RBAs, this afternoon. Who knows what's happened there? That could give us another chance to maybe buy this one at an incredibly cheap price there, but definitely some value here at the moment. But yeah, I'm quietly sort of hoping we'll get another little downward flush here. Maybe I'll get to buy it even cheaper, or maybe we'll get a first high low here or something. But we'll see after today.
Well, the last one on the list is one that has taken an absolute bath. Appen, APX, share price was 44 back in 2020. So coming all the COVID lockdowns that we had first series, the share price is down $2.39 that we can see on the chart here. It's a massive decline, multi-year decline now. And then you've got highlighted huge volumes here. Hard to see. Has it actually rallied a bit from these lows, or what's happening on the far right of the chart?
Yeah, it's a couple of things there. So this is my 11th stock here, Chris. So it's sort of, this is my, my speculator. So, probably the first 10 are probably, as much as there's no, not safe buying stocks that have been trending down for a long time. They're probably on the sort of safer side in terms of sort of, quality of company. Appen's probably a little bit more risky. It hasn't reported too well here in the last sort of 18 months. And most recently been pretty disappointing. But it is in a sector which I do think has got legs longer term. I think the AI theme is, I don't think it's just a flash in the pan. I think this is a theme which might stay with the market for a while here. I've seen a bit of volume there. Obviously, some of that's to do with the rights issue, some raised money there, but the volumes were up for the raise. But yeah, definitely a stock to keep an eye on here. I think this is just a theme which I think is not going to go away. If Appen can sort of focus themselves and get themselves heading in the right direction there, this is sort of one that potentially could recover here. Just we don't have too many quality companies in that AI space, so this might get a little bit of an uptick just because we're looking for sort of something to trade in that sector. But yeah, look, if they're going to report, they're going to sort of get their earnings back on track there, and they have partnered with some of the bigger heavyweights in that AI space as well, so that's a good sign for them. But yeah, it's going to be a long road for them, but yeah, definitely one that I think from a speculative point of view has got a chance of outperforming here.
Nice. Well, they're a good 10+1 bonus one to look at the dogs of the Dow into financial year 2024, but particularly, as you've noted, into the month of July. So we'll look at those. Are there any final words or other insights got for this type of trading or filtering of stocks?
Yeah, look, I mean, obviously we're probably trying to sort of stick with stocks that are in uptrends or, but look, with every strategy you might look at, you should be using, risk management there, whichever way you go. But yeah, look, there's history shown that some of these stocks, a large percentage of them can, often do quite well recovering sort of from these sort of larger sell-offs into those sort of financial years. So there's a good chance there. I'd probably suggest that probably 7 out of 10 will probably do all right. Maybe 1 or 2 might end up flat there, and there might be maybe 1 or 2 that continue to go down here. So that's probably the way I look at it there. So not sure which ones will be which, but yeah, it's if you are going to do something like that, then I still got to use risk management there, Chris.
Definitely. Well, that's 11 names that we can come back and check in on early part of August and also this time next year to see how they perform. So I'd say thank you for the research, preparing the list and walking us through the chart. Gary Glover from Novus Capital.
Thanks, Chris.
Gary's talked about some leading companies which are at the opposite end of the spectrum of these 10. There's a whole playlist of where Gary goes through each week, the top 30 momentum companies and the launchpad being the better ones for the week. And then there's also some trading strategies where Gary's talking about false breaks and other setups that he uses for his own trading. Finally, on that left-hand side is Gary Glover's Twitter handle if you want to follow him there.